John Williams, president of the Federal Reserve Bank of New York. John, I still have to remind myself that, yes, it's just almost a year, not San Francisco, but New York now, and what a year it's been. And of course, this year hit hard by this escalation of the trade war. You know, first the U.S. broadening the tariffs, boosting the tariffs, China retaliates. When you look at the economy, what do you see? A potential economic shock or just sort of a manageable bump in the road?
Well, I would just start from where we are today, and that is the economy is in a very good place. We're seeing solid economic growth, really good job gains, very low unemployment, and inflation a little bit below our target, but I think in a pretty good place. So we're starting, I think, in the big macro picture in a good place, and I think we got monetary policy in a good place. What we need to do at the Fed, and looking ahead of whatever happens, whether it's effects of trade issues or others, is really just keep our focus on achieving our goals, which is maximum employment, price stability. Again, I think we're close to those goals now, and adjusting our policy stance for whatever happens so that we can best achieve those goals.
Well, John, let's look at first quarter growth, since you said the economy is in a good place. It's not that it's in a bad place, but when you look at that 3.2% headline print on GDP, it looks great. But when you look inside the report, you see a lot of that was inventory building. And when you look at business investment, which flattened out, when you look at consumption, which slowed pretty sharply in the first quarter, so that final sales were up just over 1%, you get a very different picture. And it seems to me a picture where I have to ask you, is this economy vulnerable to a trade war impact at this point?
So first of all, I agree with you. You don't want to overreact to one data point or two data points up or down. And so when I look at that first quarter data, you're right that there are mixed messages there. What we've seen since that first quarter GDP, in terms of retail sales, consumer spending, and other economic indicators, and importantly, employment growth, is that the economy has rebounded pretty solidly after a bit of a soft patch late last year, early this year. So reading through that data, again, I saw definitely a weakness in the economy late last year, early this year, but signs of a nice rebound. Again, I think the economy is well positioned to deal with, whatever events can happen in the future.
Where would you look for signs of weakness? Where's your? You've got to be watching this closely. Everybody at the Fed's got to be waiting to see what happens in the politics, but more importantly, where will you look to see worrisome signs in the economy? This trade war is taking a bite.
Well, one area that we're obviously been focused on for quite some time is business confidence, consumer confidence. Again, those are areas that we saw kind of turn down late last year and now have rebounded. So looking at confidence, looking at investment in consumer spending. I mean, if consumers lack confidence or are worried, or businesses are nervous about what's happening around either in our country or around the world, they're more likely to pull back on their investment and their plans. Right now, the data, I think, again, is kind of for solid growth, but those are areas we'd be watching for signs of weakness.
Sure, because what happened a couple of months ago is not where we are now. What we're trying to figure out is where we go. And in this sense, a very important point a lot of people have made is it may not even be just the, slice and dice the numbers. What's the economic impact? What's the bite that's taken from a trade war? It's the financial market. It's the volatility. It's the uncertainty there. That's the threat to growth. What do you see on that front?
Sure, and let me just start with that first point. In terms of what the effects of the tariffs are in terms of growth and inflation, we've already seen some effects. I think a little boost to inflation, some subtractions maybe in growth, but those are relatively small so far. Now, as these tariffs get larger, assuming that happens, I think the effects will be bigger, both boosting inflation in the next year and probably having some negative effects on growth. But I do agree that the real issue is about confidence, about uncertainty. When I talk to business leaders around the country, what I hear are, when you're uncertain about what's going to happen with policy or with the economy, you pull back, you hunker down, and you wait to see what happens before you make those investments or hiring decisions. So that's where I'm more focused on, is really about confidence and uncertainty.
We've had a pretty big drop on the stock market. That doesn't only hurt confidence, it tightens financial conditions, something the Fed is watching very closely. When we saw the transition on Fed policy from December into January into March, we see that that seems to have been one of the things that was clearly on the radar screen, a big pullback in stocks and what it could do to financial conditions and what that could do to the economy. What do you see now? Because it hasn't been too pretty the last few days.
Well, one thing I would separate is between volatility and markets move up and down. That's what happens. But more focus, like as you said, on the broader and more persistent movements in financial conditions. Because you're right, if the financial conditions tighten, that affects households' willingness to spend, businesses willing to invest. And so that is something that is one of the factors that we take into account in thinking about where the economy is likely to go. But the big picture, there's a lot of things that affect the U.S. Growth, and the fundamentals are still pretty solid. Job gains have been good. Real wages have been growing. So I think a lot of the underlying kind of momentum in the economy is still solid. So sure, watch financial conditions. It's an important input into thinking about growth, but not the determining factor.
And John Williams, President of New York Fed, I just want to again thank you for joining me here in Zurich. We've never met in Zurich before, and I also want to thank our radio audience who's joined us in this very important Bloomberg television discussion as well. When you look at the landscape, the Fed has not been including a balance of risk statement so much. But let's say I will, John Williams today, where does this leave us in terms of a balance of risks? Trade war has started. We don't know the impact. We know that there were some vulnerable parts. I mean, again, weaker consumption, not good business investment in the first quarter. Do the risks tilt to the downside now?
So let me step back a little bit to last December and thinking about that balance of risk. Clearly, what we saw late last year or early this year was slowing global growth and clearly financial conditions tightening. And those are the two areas of risk that I've been particularly focused on. What we've seen on the international front is China's data, China's growth is coming better, in part because of the policy actions that the authorities have taken there. Europe is still a mixed picture, and we've seen some weakness in Japan and Korea. So on the global growth side, I think there are some downside risks there. Financial conditions have overall improved quite a bit in the last few months. So I would say overall the balance of risks is roughly where it's been as it's changed a little bit, but still kind of roughly where it's been. I think one thing we don't want to lose track of is the U.S. economy is still steaming ahead through this. So the data, the U.S. data has been better than expected. So, everybody talks about the downside risks, as we should, and focus on that. But of course, we've actually seen some pretty strong numbers in employment, unemployment that tell me at least that the economy still got good momentum.
Look at the markets. Look at the bond market rally. Yields continue to fall on the benchmark 10-year. Does that send a strong signal? Look at the fact that the yield curve from 3s to 10s briefly inverted again and is still very flat. Look at the fact that the Fed funds futures market is once again pricing in at least one rate hike in 2019. Are the markets reading the Fed's reaction function accurately?
Well, it's always hard to know, whether what they're thinking about market participants are thinking about. Clearly, this issue of downside risks is very much in investors' minds, and that's understandable given some of the factors we just talked about. My point of view is always look at the medium term. Where's the economy going in terms of our employment, in terms of inflation, and just try to keep monetary policy in a nice balance, place to keep a nice balance in terms of our goals. So I'm not going to opine whether the markets are right or wrong, because we'll have to wait and see how the data come through and how these risks materialize or don't. And we're in the Fed, we're in that mantra of data dependency. What that means is continuously reassess what are the data telling us about the economy, the outlook for the economy, and really focus on this medium-term view of how do we best achieve our goals.
Well, the Fed has certainly said that the next move could be in either direction. You'll do what's appropriate. So let me just go a little bit further on this. When does the damage from a trade war, if it continues, people are not looking for anything to end quickly, and once even if there starts to be some deal made, the tariffs may stay in place. So when would it become severe enough that, what would the cues tell you, gee, it is time to start looking at a possible rate cut?
So first of all, I do think of the tariffs as in a way is like a negative supply shock. And so it has various effects in the economy. One is it affects inflation. It probably will boost inflation by a few tenths over the next year. It affects demand and growth a bit in the short run, but it also has negative effects on the kind of the value chains and how our economic system works. So I think in thinking about that question, we just have to keep assessing, evaluating what are we learning from the data in terms terms of those effects, but also the broader set of developments that we're seeing. So I don't think there's any threshold or any specific point. It's really just assessing where we are in inflation in terms of our goal, because we need to get inflation back to 2% and keep it there on a sustained basis, at the same time of making sure that we can sustain this economic expansion as long as possible. So we just have to just assess and evaluate.
Inflation is the other side of the tariff equation, to be sure. Last year, the economy was somewhat shielded by the tariffs because they weren't so much on consumer goods, because China's currency declined, and that helped offset the impact on U.S. importers. How big of a boost in inflation? And again, back of the envelope, we can't be sure. How much could this boost U.S. inflation this year?
So it's hard to know. So I'll start with that and I'll end with that. But I think based on, the research that's happened, the studies have been very detailed looking at this. We could probably get a couple tenths or 2 tenths on the inflation rate over the next year based on what's already been announced. If there are further escalation in terms of tariffs, those effects would get even larger. And you're making exactly the right point that this is, starts affecting consumer prices as these tariffs are applied more broadly, and the consumers start seeing it in terms of the prices they're paying at stores. So that's definitely a significant effect, but something obviously will be part of our analysis and watching how the economy is doing.
Would this be a relief to the Fed after persistent inflation shortfall, or is it the kind of thing that could start inclining the Fed on the other side of that rate path towards a rate hike this year, because some people are starting to opine that, if it boosts inflation enough, that maybe the Fed would feel that it's more appropriate to start thinking about taking that step?
Well, again, it all depends on all the factors that are happening and assessing the outlook for the economy. Typically, in the past, I would say a change in the value of the dollar, or I think of the tariffs in a similar way, affects inflation only for a year or so. I don't see it as a factor affecting underlying inflation over a longer period or inflation expectations. So I think you can look through that a bit. You don't want to overreact to those movements. At the same time, clearly a big movement in inflation, if it were to occur, would be something that we'd be studying carefully and trying to make sure we understand how do we keep inflation right around our 2%, symmetric 2% goal.
John, at the conference you attended here in Zurich today, which is an International Monetary Fund, Swiss National Bank conference, your panel was broadcast live on the website. And in your prepared remarks, you emphasize that in a world of lower growth, due a lot to supply side factors like productivity and an aging population, a world where you're so close to the zero lower bound. It's very important for central banks to reassess their toolkits, et cetera. It seems, does this also show how important it is which way the Fed errs? Does the Fed err then in a world like that on, maybe inflation's heating up, we should be looking at rate hikes? Or does the Fed say, we really can't afford another move towards the zero lower bound? And if anything, our vigilance has to be in avoiding any kind of downturn in the economy, particularly at a time when a trade war may hit it hard, or at least hit it some, and make it more vulnerable.
Well, I do think that the risk management aspects that you're highlighting are really important at all times for monetary policy, but especially when interest rates are near this lower bound that you were talking about. That was definitely a concern and a consideration as we kept interest rates low for 7 years and took our time bringing interest rates back more to more normal levels. This idea that you have to manage those risks is what happens if something negative happens and pulls the economy back down. Now that we're kind of more in a normal economy, I think with good momentum, those concerns are still in the back of my mind to think about that. But really, I think right in the current situation, the focus has got to be on keeping the expansion going and also keeping inflation, getting inflation right on our 2% goal. So these lower bound issues are important. They're definitely in my mind in thinking about this risk management. But right now, I think we're in a pretty good place. We're well away from the lower bound, and I think our policy choices are again, we're in a good balanced place for that.
In your work and your economic research, you focused a lot on the role of inflation expectations and how important it is not to let them get anchored at too low of a level. So I want to ask you this. Has the Fed had some role in depressing inflation expectations? The Fed started raising rates long before inflation was anywhere, in this cycle, long before inflation was anywhere near the 2% target. It kept raising rates, gradual rate hike path, as inflation still was far from the target, maybe getting closer. But do you think, with hindsight, maybe the Fed could have handled that differently? Is that part of the reason why inflation, far from being at or above target, as some say it should be for a while, is below and falling.
Well, obviously, the experience of the last several years has caused many of us, including myself, to reassess the inflation process and the factors that drive that. One thing that we've done at the New York Fed and in the Federal Reserve System is really re-examined, how low we can get unemployment without creating inflation. And I personally, and I think others, have lowered their estimates of the natural rate of unemployment, or how low unemployment can go before it ignites inflation. So that's a good thing. I mean, that allows us to be content with an unemployment rate that's much lower than we used to think was sustainable in the long run. So definitely reassessing kind of your assumptions, your models, everything is an important part of that. I do think there's a broader issue, and I want to go back to this framework review, that I think we can do our very best to get inflation at around 2%, keep it in that around 2%. I do think these challenges of a very low neutral rate of interest, the lower bound, tell us that all of us as central bankers, including the Fed, need to think very hard about how do we best frame our policy strategy, how do we communicate that strategy, and how do we execute that strategy, given that this lower bound issue is going to be a recurring aspect of our policy kind of policy reality in the future. This is something we are doing at the Fed, and Vice Chair Clarida is leading that effort, something I think is very important for us over the next year to really think about. Let's make sure we got our strategy right, that we communicate that effectively, so that we can do the very best we can in the future.
When you look at what's been happening with inflation, though, recently, when you look at the fact that there is a trade war on the table, have you seen anything? And again, I want to put those two, because those are two big reasons for people to say, hey, maybe the next move is a cut. Have you seen anything that would at least change your dot for this year? I don't even know what your dot is. You can certainly tell us now if you'd like. But I just wonder, is there anything at all that makes you at this point say, I know you're assessing, I know you're in your right place, I know the economy's in a good place, but is there anything at all that's shifting you towards that direction?
Well, again, I would say that some of the risks that I was worried about before, about maybe the economy slowing faster than we were expecting, that has diminished because the economy seems to have momentum. The events in China have given me a little bit of comfort that they're not going through a hard landing. The lower inflation data obviously is on the other side of that, and some of these other concerns around trade and other factors. I think there's a lot of risks out there. Fundamentally, I think the policy is right in the right place. I don't see any reason to have a bias upward or downward in the current circumstances. But again, we're going to evaluate, reassess, and see what's the best decision to get us to our goals.
Well, John Williams, thank you so much for joining us here in Zurich. John Williams, President of the Federal Reserve Bank of New York.